So I believe dividend investing is having its moment again. You can feel it in the comments, the search trends, and the way it dominates everyday discussion about where to get the highest yield on your money today. So with the rate cut expectations around the corner, investors are hunting for something that beats savings rate without rolling the dice on growth stocks. So when investors ask, are there options beyond the usual 4 to 5%? Business development companies, or BDCs for short, often come up as one of the route worth understanding, as some of them actually offer potentially up to high single-digit yields. In this video, let's unpack how they work and what trade-offs come with them. Let's start off with the cleanest definition possible. A BDC is a publicly regulated vehicle whose job is to lend to smaller, non-public businesses that can't easily tap into the bond market or raise equity cheaply. In essence, BDCs actually step in as direct lenders. And most of what they do are actually called secured first lien floating rate loans. I know they sound incredibly tough to understand, but let me explain. Firstly, on the term secured, secured means that the loan is basically backed up by something, an asset and collateral. You can think about things like buildings, equipment, or even IP. First lien means that if something actually goes wrong, this lender has the first claim on their collateral and gets paid before any other lenders. And thirdly, the floating rate means that the interest resets with market benchmarks like the SOFR. And for those of you who are unaware, it's the secured overnight financing rate based on the overnight treasury-backed funding rate. So payouts actually move with the rates themselves. So some BDCs may add things like a second lien and mezzanine loans to boost yields. So second lien is still collateral backed but paid after first lien, hence the higher risk and the higher coupon payments. Mezzanine actually sits further down the stack, often unsecured or lightly secured, so it pays even more but takes the losses first if anything goes wrong. So BDCs oftentimes may also take small equity stakes or warrants alongside the loan, and these don't change the interest you collect but can add upside if the company grows or even exits well. So as an investor, you can think of yourself as buying a vehicle that pools many of these positions, collects the interest rates, and passes most of the income to you as the form of dividends. And as such, BDCs could either be private or listed on the stock exchange itself. Now, the big question on most investors' mind. Why do BDCs pay so much more than the usual income products, such as your bonds, your dividend stocks, or ETFs, and even REITs, your real estate investment trusts? So there are three structural reasons, and they'll sound pretty intuitive once I say them out loud. So first, it's the risk premium. These borrowers that are borrowing money from the BDCs, they're not investment-grade corporates with great or pristine balance sheet, and they don't have 10 different investment banks fighting to lend them money. So they tend to be good businesses in that in-between zone, but because they don't have the cheapest options of financing, they pay higher coupon, or in this case higher interest rates, and that premium actually accrues to the lender, which is the BDC in between, and then to you via dividends. Second, it's the idea of floating rates. So when policy rates actually went up, coupons on these loans actually reset higher at a very frequent basis. So the net investment income actually rose, and the BDCs increase their distribution to you. And if the rate tend to drift down over time, coupons also reset and the distributions to you too. Third, BDCs are also structured as regulated investment companies. So to keep their tax-efficient status, they're required to distribute the bulk of their taxable income. And that naturally results in a higher payout ratio than, say, a matured stock that retains part of their earnings and only pay out a small portion of it as dividends to you. Now, let's zoom out for a second. Where do BDCs actually sit in this broader private credit universe? So private credit is essentially just lending that happens outside the public bond market and outside the traditional bank balance sheet. So for institutions such as your pension funds and your endowments, an exposure to private credit has been a core allocation for years. And the twist is this. BDCs open the door for regular investors like you and me. So listed BDCs trade basically like any stock. You can buy and sell them daily, and that's very different from the private direct lending fund with a 5 to even 10-year lockup period and quarterly mark-to-market numbers. And clearly, there is a trade-off. Listed BDCs have visible price volatility and can swing to a premium or a discount relative to their underlying portfolio value. Non-traded BDCs tend to smooth all of it out on the surface, with lesser pricing frequency, but you give up flexibility. So before we get carried away with the 8-10% yield chart, I think it's worth answering the skeptical version of the question. If this is so good, where's the catch? So the first risk that investors has to be aware of is definitely the credit cycle. So let's not forget, BDCs, the loans that they do are to smaller, non-public businesses. So in recessions or profit slowdown periods, some borrowers will definitely stumble. So when a loan stops paying interest, it goes into non-accrual. And enough non-accruals happen at the same time, and your net investment income definitely drops. The recovery from there then really depends on the collateral quality and how aggressive the underlying was in the first place, and whether you are able to recover all the loans. Second is clearly leverage. So BDCs borrow too. Sensible leverage helps boost return, but too much leverage magnifies the pain when the credit spread widens and marks come down. So listed BDCs trade at a premium or discount to their reported net asset value per share. And that market sentiment layer can both help or even hurt you. So buying a great BDC at an absurd premium might set you up for disappointment, even if the underlying loans perform. While buying a decent BDC at a steep discount can boost your forward return if the gap eventually closes. And the last piece is of course the idea of the quality of the manager. So two BDCs can run on the same headline yield, but one might have better underwriting, better workout teams, and a stronger deal flow, and a much more conservative balance sheet. And we all know who would win at the end of the day. So with that framework in mind, let's try to compare BDCs with the other income assets. So against REITs, the similarity is that both structure pass through most of their income. The differences is what sits underneath this entire asset structure. So a REIT collects rents intuitively through their real estate portfolio, and a BDC collects loan interest. So rent tend to move with lease resets and occupancy, while loan coupons move with reference against the rates and the credit spreads. So against dividend-paying stocks, I think the difference is a lot clearer. A company can cut its dividends at the management's discretion, sometimes for very good reasons, like potential reinvestment opportunity, while the BDC's distributions are solely anchored in the cash interest they're generating after expenses. And versus bonds, BDCs generally offer higher yield because you're taking on more credit risk and layering on an equity-like volatility of a listed vehicle. And investment-grade bonds are lower yielding for a reason. So high-yield corporate bonds sit closer in spirit to parts of the BDC universe, but they're still public securities with different liquidity and different asset dynamics. So none of these factors actually make BDCs better across the board. It just explains why they sit higher on the yield spectrum. So one nuance that often gets missed out is how the floating rate dynamic can be a friend or a foe in different regimes. So in a rising rate environment, BDC coupons actually reset up and dividends follow suit. And in a falling rate world, coupons actually reset downwards. And the offset is that the credit conditions often improve when policy is in an easing mode, but it's not a one-for-one trade-off. And that's also why looking at a BDC's history through more than one economic phase is useful. You can ask questions like, did the net asset value hold up? Did non-accruals spike in bad times? And did they have to issue shares at a discount? And did they cut the dividend? And how quickly did they rebuild it? And these are important questions to ask when trying to analyze the different BDCs. Let's address the elephant in the room. So is a 10% headline yield actually achievable? The honest answer, yes. Because historically, some of these BDCs have delivered in that range. But it depends heavily on the credit quality, leverage, and market conditions. So it's not a guarantee and it's not free of volatility. Some quarters will definitely be higher, with some lower. And the headline number is only attractive if the quality underneath it is actually real. And one important feature that stands out for a high-quality BDC, on top of the quality of the loans they issue, is diversification. So large BDCs lend across hundreds of companies and many different sectors, from software to healthcare to industrials to consumer staples, so on and so forth. And that spread matters because in credit investing, you are managing probabilities. You'll never get every loan right, but you want the math to work across different market cycles. And of course, across different market sectors as well. So ultimately, where does all this land for someone who's exploring income ideas because the rates are going down? So the reason why BDC yields are higher is not a mystery. It's a function of who they lend to, how these loans are priced, how the interest resets, and how the vehicle is regulated. And if you keep those truths in tension, BDCs can make sense in a well-diversified income portfolio sitting alongside things like quality investment stocks, investment-grade bonds, and high-quality REITs. And if you want the full playbook for building up an income portfolio with BDCs, knowing how we read the financials, track non-accruals, stress test payout coverage, and avoid overpaying, Adam Khoo's Income Investor course covers it all, and you can learn more about it with the link below. And with that, this is CK from Piranha Profit signing off. Till next time, keep winning.